Rohit Srivastava is joining us now to talk more about markets and charts. Rohit, I was just telling Anisha that you're not a regular chartist and you do look at the market with the lens of charts, yes, but look at other things as well, overall scheme of things. Are you gauging early signs of froth in the market? The volume data, the bulk deals, margin funding is rising as well. Is it getting reflected on your screens?
So while there can be some signs of concern, say, for example, I'll give you one data point. FIIs have built up long positions of over 90,000 contracts in the futures market on index futures. Now, we've seen the similar kind of number when we peaked in December. We've seen it a few times before. So whenever we get this kind of data point, we have to also reflect upon the trends that we are really seeing from a wave structure perspective. So when we start talking of waves, we start talking of psychology. Has the behavioral pattern also start, on the charts matching with what the sentiment is really showing? Because sometimes in an extended market, you can get overbought readings that start concerning you, but the market continues to chug along. And therefore, jumping the gun on data alone can sometimes become wrong. And that is where you have to be a little careful when you look at these data points. So purely looking at the momentum structure, the structure of the market doesn't tell us anything to be concerned of beyond maybe a 1 day, 2 day, 3 day kind of a correction or a pullback, if at all it happens. So say on the Nifty, I would say you have support closer to 19,200. Or on Bank Nifty, your support closer to 44,900. I'm not so sure whether we'll go meaningfully below that. So we can get a pause, we can get a small pullback, but probably the trend higher will still continue from here, because what is ending up happening at the floor level when you actually see the breadth of the market and the participation is that there is rotation from one sector to the next and to the next. And you're kicking in participation from large caps like Reliance Industries that have actually not moved in the last 2 years. And when you start seeing that kind of behavior, it tells you that something or the other can keep the index, propped up, and you might not get any steep correction. So that's I think the first conclusion that we're really coming to. The second one, based on data alone, again going back to that FII number, is something that I've been thinking about. Is historically, we've seen long positions even go up to 300,000 contracts. And this was before PN note bans and all were in place, and activity of FIs and probably reduced in terms of the size of positions they would have long or short. So after 2016, we've never seen them go to those extreme readings. Their readings have been in a narrower range, So even, say post-COVID, we have really not seen positions go beyond 120,000 contracts on the long side. With FIs. So moment you can come close to those kind of numbers, you start wondering whether it's at the end of a move. But, this year we also introduced, PN notes through, Gift City, which is the new in the budget announcements. And so if that leads to an expansion in position on the derivative side, that's something to be seen and watched. Then can these numbers really go back to where they were, in previous peaks prior to 2015-16, So that is why I'll not jump to data conclusions yet. I think price and trend readings are pretty strong, and they should help us, continue to ride this move higher. What you do is, try to make the right, sectoral shifts from time to time if you're really managing active money, because there could be rotation. But overall, we are witnessing everything join into this move. Let's take another example is the tech sector, right? It was languishing for a pretty long period of time, a lot of negative sentiment around Indian tech stocks.
I'll just come in over here. Let's break down that discussion into parts. Your point is very valid and point taken. Let's talk about the areas of the market which are coming back to life after a gap. Do they present opportunities? PSU banks. For 2 days, there are sparks of activity in mid-tier PSU banks. Even SBI has woken up from its slumber. It peaked out two quarters back after a good set of results. Any opportunity you see in PSU banks from here?
I definitely do. I think the pullbacks in them are mostly complete. In fact, when you mention SBI, it's probably out of all the PSU banks had the steepest retracement. So when we say from the peak of December to the bottom in March, SBI would have done a 61% retracement. Now I'll just highlight as I'm talking about stocks. We don't really give investment advice. We are not advisors. So everything I'm sharing are basically opinions and observations. So SBI retraced 61%, which was deep. But if you look at the alternates, Canara Bank, Bob, for example, Bob has been much stronger and did not give that kind of a deep retracement. But having done that, once you've done that retracement, we are seeing positive momentum in the sector. And that sort of means that, the upward trend has resumed. And that's broadly with the entire banking. PSU banks are definitely doing much better than the private banks as of now. But banks in general are leading from the front. I was just looking at the Nifty gainers, and at least that out of the top 10 gainers, 4 to 5 will be financials, and so that's just the mood right now, that financials are leading the way.
Sure, Rohit, just wanted to continue that point when you talked about sector churn. Do you finally see value emerging in the IT names as well? And within sectors as well, we are seeing this churn, right? For instance, for FMCG, the bulk of the rally has been led by ITC. Do you think that will continue, or the likes of HUL and the other beaten down names will take charge now?
So what happens here is there are two things to mention. One is, people who look for relative performance, and second is absolute performance. Now, on an absolute performance basis, when you do kick off into a bull market, which is what I would want to call this, is a resumption since March of the bull market that was going on after a long 1.5 year consolidation. In that, you'll get participation from each and every sector, which will include FMCG and IT. Even I'm waiting for metals to kick in eventually. But what you will get is a variation in performance. So within tech stocks have been beaten down. There are a lot of concerns among large cap tech, but the ones that are really doing well are the mid cap, smaller tech stocks where there are special, events around growth really taking place. So the high returns have really come from the smaller IT companies, not the big ones. And so will you continue to chase the big ones becomes a question mark. Similarly, FMCG goes through, 10-year cycles, like they did exceedingly well in the 1990s. But when the actual bull market and the economy was going on, when the core sectors were doing well in the 2000s, FMCG sector underperformed for an entire decade. Then again, they did exceedingly well between 2010 and 2020. So I think we are in another phase where they will tend to underperform the overall market, which doesn't mean they go down. They will tend to, do well and rotate. But because they've been through that big run and their valuations are high, they will tend to move up much more slowly than the rest of the market. So those are not places where I would have major allocations. You may like, like I said, mid-cap IT, or you may like some of the FMCG names which are showing higher growth than the rest for some reason. So you can narrow it down. But I think those will remain underweight sectors for people who are looking at relative performance as such. And then absolute performance, on a relative performance basis, what would you chase is the ones that are really doing well. So that again takes you back to capital goods, defense. Those are the sectors that have been on top of this move, and now mid caps. So a lot of the mid caps have outperformed in the recent 2 months, and I think that's a trend that will probably continue for the rest of the year.
Has hit a record high again, but it's just moving higher. So every day, just a matter of record. What about the NBFC space, the technology-led consumer NBFCs? Yesterday, it was a day of 7% move. Bajaj Finance today, Poonawalla Finance after a good Q1 update. Have you looked at this space, at the NBFC space, Rohit?
It's there. It's definitely there because, but there's a segregation, and we define some as new age tech. When you talk of companies like Paytm and then you talk of Bajaj Finance, it's hard to put all the baskets together. And always, when we see the market as technicians, we actually wait for a company to be around for at least one bear market cycle before we can say that, okay, now we are ready to look at it more constructively. So when it comes to newly listed companies, which is most of the new age companies, we actually are, don't still have a firm view on their overall pattern till they've been through that kind of a cycle, because you don't know what kind of unwind can happen once they get listed. But yes, of course, the other NBFCs which you're talking of have been around for a long time, so they do show strong price performance. And even though there's been a lot of pauses in between, overall, I think their performance compared to some of the private banks has been better. So they will also, definitely remain in focus.
Thanks, Rohit, for joining us today.